thanks everybody for joining in. This is Study Time with Steve. We plan to do this as of this year just twice, so once in the spring and once in the fall. The kind of overview of what we want to do here is I'm going to have one of our wealth managers come on with me, and we're going to go over a few slides, things we've been looking at and reading recently, and talk about those just kind of like we would in the office. So you're going to get a backstage view of kind of what goes on here day to day. With joining me today is Mike RAZZOUK. He's an executive wealth manager with KWB. I'm Steve Gormley. I'm the director of portfolio management here for the firm. Here, let me get this out of the way. We got some general things for the lawyers that they need to see. The other thing I would like to say is that these views are not necessarily the views of KWB. These are the views of Mike and myself, and that's pretty much it. So, all right, let's get started. So first thing I want to talk about is, I think Mike and I both have this proclivity. We like to be right, and being right in the market and everything is really, really difficult. So I'm going to bring up this slide. The thing I like to say to myself is, if you're not right, just wait 5 minutes and you might be right later. But here is a slide that shows over the last, I want to say it goes back to 1950. Every year in the S&P 500, when January is up 5% or more, what happens for that year? So it's an average of all of those years combined. And as you can see, this February through April period tends to be a consolidation time when we have a January that's up as much as January was this year. And so this is pretty normal going through this consolidation. Now we've had other things happen in the last few weeks. I had this slide picked before the bank collapse, so that changed things a little bit. But what I'll say is that we really don't know. But all we can do is kind of go off of history. I'm sure in some of these years, there were things that happened that looked very much like a bank collapse. And so what we can take from this is that in general, the market tends to go up when January is good. The other thing I would say is that in any year, the average year, we tend to get a consolidation in February, March, and April. The thing to really note is think about COVID, think about the great financial crisis in 2008, 2009. Where did the market bottom? Market bottomed in March in both of those years. So really what we're going through, even with the bank collapses, is pretty normal. So what do you think, Mike?
Well, I think a couple things. So it follows that adage, what happens in January, as goes January, so goes the year, right? Is kind of the joke. And last year we had a terrible January, and then we had 2022, which nobody wants to relive. But yeah, we actually had way better of a January, I think, than what we were ever anticipating to happen. So it's normal for markets to take a little bit of a pause. And then, the big question is just going to be, sell in May and go away, Steve? I mean, that chart looked like it actually completely debunked that.
Yeah, let me bring it back up. Because, yeah, I mean, I guess in those years, it's not that way. And when you look back in history, sell in May and go away is a nice slogan because it rhymes. But other than that, it tends to be pretty fickle when it comes down to it. Again, I think, like I said, we both like to be right. I think we go about ways of being right because we'll get questions from clients like, what's going to happen the next month or next 3 months or next 6 months. I have no idea. Right? And so the best way to deal with those questions is, again, just wait longer. I have a chart that I literally keep in my office, and I'll bring that up next time, that shows over history, what you can expect day to day, month to month, year to year. And so on a day-to-day basis, the market is basically a coin flip. So if you want to be wrong, 50% of the time, just go ahead and guess what the market's going to do the next day. But if you want to be right, wait 10 years and you'll be right because the market, almost always has gone up over a 10-year period. So it's my way of being right is just waiting longer.
Yeah. Well, I think another takeaway too, like when we're just trying to evaluate this year in general, is we're coming off of a negative year. It's really rare that we have 2 negative years in a row. I mean, it can happen. You go back to tech crisis, 9/11, things like that.
Yep.
But that usually is some kind of extra abnormal event that kind of causes that. So, there's some potential good news here that we're going to be exploring today.
Yeah. So let's go to the next chart. Another one. If you really want to be wrong, then guess where interest rates are going to go? Because this is a chart showing professional forecasters. So these are the pros. These are guys who look at this all the time, who are trying to guess where the 10-year interest rate will be on treasuries. And you can see that they've, for about 20 years now, they've been guessing they would be going higher. And, they finally got their wish last year. It probably went up a lot faster and a lot quicker than they would expect. I don't have last year's guesses on here. But yeah, I mean, when it comes down to rates, to even just think about what's going to happen later today, I think it's still a coin flip whether the Fed is going to raise this afternoon or not, because they're in a tough spot today. What do you do? You've got a bank collapse, so you've gotten kind of something broke. You've gone through the motions of raising rates so quickly, and something finally did break. And you've also got to save face from saying, yeah, we're going to keep raising rates to fight inflation. So this is a difficult one. So if you really want to be wrong, then try to guess where rates are going to go.
Should we make a guess? Are they going to raise today? Or
again, I say I don't want to be wrong, and then we're going to make a guess. But again, it's such a coin flip. I think they'll raise today, 25 basis points, and then I think that's it. I think they'll stop there.
Yeah, I'm kind of with you. I think if they don't raise interest rates, then it's like, what do they know that we don't know?
Yeah, right. Yeah, it could be. Yeah, it could be the, good news is bad news and bad news is good news. I think it's such a coin flip right now. I'm interested even to see what will happen. For everyone who is on this call, expect for the market to be just bouncing around, going nowhere until 11 o'clock, and then when the news comes out, it will probably either go up or down, and then it will go back to kind of probably flattish, depending on what the FOMC says. So it's going to be an interesting day. But yeah, both of my charts are basically saying it's really, really hard to be right. So the best thing to do is be diversified, be long-term. Our investors, the people who we work with, they're all long-term investors. And that's, when you're asking questions over the next 3 and 6 months, that's not the time frame that we're thinking in. We're thinking in 5 and 10 and 20 and 30 years. And that's how you build plans, right, Mike?
Oh, absolutely. So, I mean, clarifying your chart, like the little dot plots here, that was the expectation. That was the guess. Right. And I remember as soon as I started in this role, I mean, all the way back in 2007.
We both started right around.
I mean, interest rates like definitively were going up, right? I mean, it was like every meeting, okay, guys, interest rates are going to go up. You better watch bond positions. And then we had them just go down and down and down until 2021, which they're just zero.
Yep.
So yeah, I mean, they've been going down our whole career or up our whole carear.
Yeah, pretty much.
So it was interesting to actually see it finally happen last year.
Right. But again, if you look at what are forecasters thinking, at least on the short term? On the short term, they're actually predicting that the Fed will lower rates later this year. So even if we do get a hike today, even if we get another hike, in a month or two, the market is still thinking that the Fed is going to have to lower rates at some point this year.
They're pricing in a 1% decline by the end of the year, I think, in rates. I mean,
it's pretty steep.
That's a pretty big change.
Yeah, it's pretty steep. So we'll see. My thing with it is the Fed doesn't even know what they're going to do until they actually do it.
Well, they're data driven. They're looking at the data. What does the data say?
Yeah, exactly. So, all right, let's go on to the next one here. This is Mike's chart, so you can start talking about this.
Yeah, so this was an interesting one to me. And so the reason why I put this on here was, you're sitting here last year, in December, it was a 90% chance we were going to be in a recession, right? And then all of a sudden, we had this massive increase in stock prices in January, and it was like, wait, are we going to have a soft landing, or are we going to have no landing? We just had all this landing scenarios. I don't know why everybody associates the economy with landing a plane, but that's the Fed speak on it. And it was like, what is not breaking here? And I guess this chart really kind of summarizes it, in my opinion. It shows bank deposits. It'd be kind of interesting to see this in the last week,
Yeah.
just to see what's happened with bank deposits. But the point of this is, when you look back to 2019, look at what's happened to deposits since then. I mean, they skyrocketed with all the stimulus, with all the relief that people got during COVID. And so the consumer as a whole has more money in the bank than they did prior to 2019 still.
Yeah.
And so what do people tend to do when they have money in the bank? They tend to spend it.
Yeah.
And that's been the story of this economy. I mean, the reason why we still have hot inflation, it's because people are still out there spending. They're still buying stuff. And maybe it's shifted a little bit from products to services. We couldn't go on trips for many years. And so now people are satisfying that pent-up demand to go travel, but they still have more money in the bank than they did prior to 2019, when things really started getting crazy.
Right.
So the thing that's starting to occur is those balances are getting smaller. They are coming back down a little bit to more historic levels, but they still have a lot of excess savings to get through. And the big question is just, do people continue to spend their way through this to the point where we don't have a recession? I think that was the big turning point for the market at the beginning of the year. Is just, holy crap, we're sitting here, nothing's broken yet, and yet people are still continuing to spend.
Yeah. Yeah, I mean, I should have drawn it on here, but a straight line,
trend line,
just going up. We're probably still quite a bit above that, so there's probably still some more cash to go through. The other thing to think about here is, where's employment right now? People have jobs, people are making more money. There's very, very low unemployment at this moment. So could we see this continue? I think so. I think we can see this trend line come down a lot slower. But then again, once the trend gets back to that line, I bet you anything what will happen is it'll go to that line and then start going back on it. I mean, that's typically what we see in these types of charts, is whenever there's a big spike up or down, you get back to that trend and then go back. So let's go to the other one, because that's an interesting one too. It's kind of the opposite.
Right. So this was like outstanding credit, essentially. So, what was interesting about this was, again, you could kind of see that correlation with the other chart, where we had people getting more money. And so what did they do? They paid off debt, which was nice to see back in 2020 and 2021. But then, the price of eggs and gasoline and all that really started catching up with the consumer. And you could see credit outstanding has skyrocketed in the last year. And so that is something that, like, long term is a little bit concerning, because, you can only put so much on credit cards, and then the bill comes due, and you gotta make sacrifices and spending to cover that. And so I guess this just kind of follows that same story, where it's like people have had more money, but they've just continued that spending trend. And so I guess the question is just like, are Americans now addicted to spending coming out of COVID, because it's all that you could do for almost a 2-year period? And that's kind of what looks like has been the trend here.
Yeah, the other thing I think about when I started in this business, oh man, back in the mid 2000s, savings rates were negative. People spent more than they had. Luckily, we're not in that situation now. But Kerry actually brought up a good point. I was showing him these slides the other day. He brought up a good point. It's like, both of these things, as they get back to that trend, does that bode well for inflation? Does that bode well for inflation coming down?
Yes.
As in, we don't have as much money to spend. We're going to have to start making those sacrifices. And so that does lead to a trend in inflation coming down. I think Kerry's probably spot on that one.
Yeah, well, I mean, it has to, because if people don't have the money to spend, I mean, you don't You don't have the ability for companies to just keep raising their prices, and so that's what's led to the inflation, all the excess demand, limited supply from supply chains being blocked up. So it's, in hindsight, it's an obvious problem, but when you're living through it, I don't think anybody expected it to last this long and continue as much as it did.
Yeah.
I mean, the Fed certainly didn't see it, right?
Yeah,
Transitory.
Yeah, that's another thing I should have brought up when I brought up the Fed chart is, what did the Fed actually think the interest rates were going to be at the beginning of 2022?
Well, by May they were still signaling that they thought they were going to be at like 1.5% by the end of the year, and then
they thought it would be 0.5% going into the year. So
yeah, 5 times that is where we ended, and
so even the Fed's wrong.
Well, yeah.
So yeah, I mean, when it all comes down to it, one of the people we follow, Carson Research, they put out their outlook at the beginning of the year, and they called it the edge of normal. And I think that's kind of where we're heading to. We're heading back to normal, but that ride back to normal is anything but normal. And so that's why we've got all this volatility. That's why we've got all these kind of distortions going on in the market, is because we're heading back to normal. Once we get to normal, man, will it feel better? But how long does it take to get there is a question.
Well, and I think I was questioning you just yesterday. It was like I was doing a portfolio review for somebody. I'm looking at like the 3-year return numbers now, because it's like you've had some of the drop off from like the major decline in 2020 and stuff at this point, and it's just like, wow, Steve, like people annualized with a balanced portfolio like 15% over the last 3 years.
Yeah,
that includes last year being down, but I think we're short to remember that 19, 20, and 21 were pretty ridiculous years, and so it's okay for things to get back to more normalized returns, for company earnings to go up 30% like every year. It just not really sustainable. So yeah, it's going to be a ride back to normal, and I think that these kinds of shocks to the system are healthy. It kind of resets expectations. There was just ridiculous prices for companies that didn't have earnings that should never be the case.
Yeah.
It gets frustrating for us, when we saw Bitcoin at 65,000, we were just like, why is that happening? What's backing it? And so I think Steve and I have been really aligned, where it's like we celebrated almost every Bitcoin fall. But
yeah, we're long-term investors. We think about getting rich slowly, and that's the way that most people have to do it. And I think that's the way that most people should do it, because if you're getting rich quick, there is something backing that is probably pretty darn risky.
Yeah.
Should
we talk?
Should we? I was gonna say, should we do that, or should we
talk
open
SVB?
up for questions? Because I'm sure the first question is going to be about it. But let's go ahead and talk. Let's go ahead and talk about it. So I guess if you're on here, maybe you've already kind of done your reading on what happened. A huge bank run at Silicon Valley Bank, and pretty much too many depositors left the bank too quickly, and they didn't have money to pay for, to give their depositors. And so the government stepped in, backstopped those deposits, which was a good thing. But the one thing I think about, I don't know the ins and outs of this, but the market's up since that happened. So it's tough to say, but the market is saying, hey, we think we're past this, at least for now.
Yeah, I mean, it's hard to know, because you just don't know how deep the tentacles go, I guess.
Right, yeah.
And I guess the best lesson from this is you don't know what the risks are. Nobody does, and that's why it's good to be asset allocated, be diversified, not be over concentrated in anything, because frankly, I mean, the regulators two weeks ago weren't sitting there and saying, oh, you know, hey, there's some issues with Silicon Valley Bank. I mean, they had a rating from Moody's like on that Monday, and then, you know, we're in forfeiture on Wednesday.
Yeah. Yeah. I mean, it really just goes to show, you know, be diversified. You know, if you have money in the bank right now, if it's below 250,000, you're safe. If you have a joint account and it's below 500,000, you're safe. If you have more than that, then there are options for you. So call your wealth manager and talk about those options, because that's really the plan right now. The other thing I think about is what happens to kind of these regional banks. It seems like they're holding up well through this, but you know, the regional banks are really the backing for small businesses, and so that's the scary part moving forward, is if regional banks are scared to loan more, then what happens to those small businesses? So that's right. My main concern moving forward. It seems, you know, the one positive is that it's really hard to change your bank account. It's really difficult. Nobody likes doing it. Nobody wants to do it. So that might be the positive here, is that people inertia is very, very low when it comes to changing bank accounts. But yeah, that would be my main concern. But how do you plan for that? You know, it really comes down to just being diversified.
Well, I mean, we were getting quite a few questions, just like, you know, should I take money out of Chase Bank or Wells Fargo Bank? And it's, you know, it's probably pretty safe. You know, the reality is, and I think, you know, what's kind of happening here is it's like the FDIC insurance is probably going to change, right? I mean, the banking system as a whole is probably not going to be the same that it was three weeks ago, because now the Fed has basically set a precedent of, you know, we're going to do what we can to you know, be the lender of last resort and to back depositors. And it was a sticky situation, because it's easy for us to sit here and say, well, this was all just venture capitalists that, you know, who cares, they're rich anyway, and it's okay for them to get a little reality check on their portfolios. But what about all the employees who literally wouldn't get a paycheck on Monday if the Fed didn't come out and actually do what they did? You know, so it wasn't an easy situation. And so I feel like we'd be in a worse spot overall had they not taken the action that they did. And, you know, the reality is it's going to set a different precedent and tone for banking going forward. But I feel like, you know, most people are safe, but cash management now is really important. And I know I tried to practice what I preach, and I got my 1099 from Chase. Steve, I made $19 last year.
You did it. You made a whole $19.
I made $19. I did. It was 2 cartons of eggs, and it was just like, why? There's no point, if that's long-term money, just having it sitting in a checking account. And so, you know, there's options. We've been helping people a lot with, you know, laddering treasury portfolios or just putting money in the money market. And I think that's just what people need to evaluate at this point. It's just what opportunity might I be missing with this cash versus doing something because you feel like it's at risk. I don't feel like deposits are at risk. No, but there's more opportunity.
Totally. Yeah. I mean, that's the thing, is over the last few years, last year, really, there is more opportunity now. There's more opportunity than we've seen in years, in a lot of years, in terms of that, because short-term rates were always, pretty much since we've been here, pretty much zero. There was nothing you could do with your short-term cash to try to get a better rate. So it is nice to have some options there. But again, as far as what we know moving forward, like you said, I think, you know, FDIC, all of that will change. I'm interested to see what happens to regional banks, but other than that, stay diversified, stay long-term. You know, you'll be happy in the end.
Yeah.
All right. That's the end of our talking point. Does anyone have any questions? If you do, they're down at the bottom of your Zoom screen. You can see there's the reactions button. You can raise your hand there. That would be easiest, so we don't have people talking over each other. But if you want to raise your hand and then come off mute, you can ask a question for me and Mike. All right, Linda. Let me see. Yeah, if you can come off mute.
Yeah, I was ready, looking for a place to type something in, but.
Oh, yeah, I don't think we have that on this one. We're just going to
Okay.
do live questions.
Hi, Linda.
Hi, Mike. On the first chart, the historic, raises and lowers,
Mhm.
it was pretty clear that every November, historically, there's a big dip. And I'm just wondering what you do. Do you anticipate that? I know you say, well, you can never figure out the
Yeah.
market and this and that, but it's pretty clear that that's a strong downturn
Mhm.
at that point of the year. So I'm
Sure.
just wondering, in our portfolios, do you anticipate and adjust for that prior to November? What's the deal
Mm,
with
No. I'm gonna just say
Oh.
I'm sorry that I know people want to hear that, but this is an amalgamation of a lot of different years. So 1 year or 2 years that were down 10 or 15% in that month can make it look like that, but in most years you're probably just kind of muddling through most of the time. Here's my monthly chart. I'm looking at it right now. It's right next to me. On a month-to-month basis, you can expect the market to be down 40% of the time. So 60% of the time you're up, 40% of the time you're down. So just because we're seeing that October to November part, look that way, that again, you're almost flipping a coin to determine which months to lower exposure or raise exposure.
And this may be a little bit of a charty foul too, where it's just the scale on it is pretty tight, and so it looks like a big dip, but might only be 2 or 3%. Yeah, it's a good question, Linda. I mean, everybody wishes that they had that kind of foresight to be able to say, okay, let's sell here and buy there, but the moment that you feel like that trend has been established, market does the complete opposite. And so I kind of have a saying that the market finds a way to make the pool of the most people possible. December again, the market was going to go down and retest the lows, and we were going to be at 3,300 on the S&P, and then we were at 4,100. I don't think, again, the majority of people anticipated the rally that we saw. And so when they go back and they back test that sell in May, go away adage, it hasn't worked like the last 10 years. The moment you feel like you figured it out, it changes. And so it's just not worth it to try to play that game. If you think, again, that you're a long-term investor, markets are going to go up over time, you're better off just collecting your dividend, not focusing on the price, and just sticking with a long-term strategy.
Yeah. Jerry, go ahead and come off mute.
Hi, I just have this question. I went to a Charles Schwab seminar just a few days ago in Phoenix, and I saw an impressive slide of the S&P 500, and they went from before the pandemic, through the pandemic, to where we are today. Anyway, looking at that slide, they actually talked a bit about, the pandemic was rough to go through, but the pandemic actually in history has proven to be a buying option, in the sense that you had the decline, but when you look at the chart altogether, it is pretty much you can see the imaginary steady line of increase all the way through that.
Right.
Yeah.
I guess I'm kind of adding on to Linda's question from the standpoint of, obviously I kind of I play with some of my own money as a technical trader.
Mm-hmm.
I buy the idea of diversification, and I buy the idea of holding steady straight through.
Yep.
Certainly when you look at entire portfolios and managed portfolios, you want to stay pretty much on course. If you do look at doing any type of trying to figure out when to sell and when to buy, you're probably safer doing that on almost individual stocks than
Correct.
on portfolio size movements.
Correct. Yeah, and I guess this question comes back to more of a time frame talk than anything else. So when we're dealing with portfolios for our clients on a whole, we're talking about time frames that are 10, 20, 30 years, and if you're giving to your kids 50, 60 years. So it's we're not looking at a day-to-day portfolio like you might be looking at, Jerry. And so that really is, there's a good quote from Morgan Housel. He says, you know, the problem with the stock market is really that it's just a bunch of different people with different time frames yelling over each other to try to be right. But really, when it comes down to it, it comes down to your specific time frame for that specific money. Like you said, you have one bucket that is, here's my long-term bucket, and then here's my play money that I do things more intraday. When you're managing, you know, as many portfolios as we are, the intraday thing kind of goes away, and then we have to focus on that 5, 10, 15, 20 year, those periods.
Yeah, and I would add, I mean, it goes back, I think, a little bit to my point when we're looking at 3-year numbers, where they're really, they look really good, you know, the portfolio returns, and part of that is just the opportunity that, you know, events do create. And so we don't feel you can time stuff, but we'd like to make little shifts. And you've probably seen some of those shifts, you know, just even recently within the portfolios, where if we feel like small value companies are at really, really historically attractive prices, we might move some money out of large companies in order to add to that kind of position to try to take advantage of attractive valuations. And so we feel like you can make small moves on fringes that maybe are going to add value over a long period of time. But when it comes down to just, you know, having a diversified portfolio and trying to be in and out, it doesn't bode well for most people. Most people can't make the right bet twice. Yeah. Selling at the right time and then buying right at the right time.
I would encourage, if you have that bug like Jerry does, like, you know, have a little bit of money on the side to play with. It's good for your mental health if you want to do that. But the way we're going to manage portfolios is going to come back to those long-term time frames.
I think Mel had a question.
Mel had.
Hi, Mike.
Hello.
Okay, so you know I'm more proactive around tax time. So I've been watching a lot of information about what to do in the short term, because I know KWB is all about long term. But for a safe haven, for the lack of a better word, on the money, is there anything? I've been hearing a lot about T-bills.
Mm-hmm. Mm-hmm.
So is that a safe place to go to for excess money than investing if you're not going to invest long term?
Let me answer that by saying it always comes down to, again, what Steve was saying with time frame for the money, Mel. Like if this is money that, again, you're looking at cash management, you know, this is my emergency fund that I'm not likely going to use, and I want to get some better return than, you know, the 0.02% that Chase was paying Mike.
Yes.
Then, yeah, T-bills are a great fit for that kind of situation, because, you know, again, you can ladder it. You can buy treasuries that are going to mature in 3 months, you know, 6 months, 9 months, and you kind of match the time frame for when you're going to need that money with a safe investment that's paying you a decent interest rate. I mean, the 1-year treasuries at the moment, I was checking today, Steve, it's like 4.6 now.
Yeah.
It was 5 like 2 weeks ago, but you know, interest rates have kind of plummeted with the bank issues. Yeah. But that's where those are really a good fit. It's for that money that you want safe for the short term. But again, if it's money that, hey, this is my 401k, this is my IRA, this is, you know, the money that's going to carry me through the rest of my life, then that should be invested, because you still have a 20 or a 30-year time frame, you know, and that money is still very long term. Yeah. So always match the time frame for the money with the investment strategy. And if you're under a year, it should be in safe buckets like treasuries, like money market, like cash in your bank, even to just give you that liquidity. Yeah. And so it all comes down to time frame as to what's appropriate for your return.
Yeah, the other thing Mike just mentioned is money market funds. So if you don't have a specific time frame for that money, you can put it into a money market. Yeah, exactly. I need it soon, and I might need to get it out quickly. That would be the case for a money market fund. So right now, the money market funds that we can invest in are paying around 4.4, 4.5. Now that the thing with money market funds is they will fluctuate as the Fed raises or lowers rates. So they're going to fluctuate more than a treasury where you can lock in a rate for a specific amount of time. But the problem with the treasury is, like, let's say you buy a 6-month treasury and you need the money 2 months later, there is a possibility that you can lose money in that investment because you're going to have to go out and sell that in the market. So depending on where rates are at that moment, you may lose money in that. So it really comes down to matching that money with the liquidity needs and the time frame that you have for it.
Okay, all right,
Yeah,
that's good advice. Thank you.
And I think the way that we like to think about money too is, when we're creating a portfolio, we're making buckets that, again, we think are going to match the time frame, and that's why we have a cash bucket within the accounts. If people are taking income, Steve, we've been 4 or 5 months worth of cash.
Yep.
Just to not have to sell stuff. But then we have bonds in there to kind of fill that need for the next 1 to 3 years, and then we consider our stocks really money that's going to be, longer term, 3 to 10 years or more.
Yeah.
And so we always make that suggestion first of have an emergency fund, have cash beside your portfolio, so that you have money to carry you through short-term needs without having to dip into a long-term investment to raise cash.
Yeah.
And that's just part of, again, a financial plan, in our opinion.
Okay. Thank you very much.
Yeah, thank you, Mel.
Good question.
Let me bring back the slide deck up and kind of do our outro here. There we go. Thank you all for joining. It was a fun time. Like I said, we plan to do this at least one more time this year. Depending on how it goes, it looks like we had a really good turnout. So maybe we'll do it more starting next year. The one thing I would like to ask, if you are on Twitter, go ahead and follow me at KWB_Steve. I try to put 2 or 3 charts a week on there that I'm looking at, or blog posts or things that I'm reading that I find interesting, that I think our clients will find interesting. And again, if you have any other questions, please feel free to call in and talk to your wealth manager. But other than that, I hope everybody has a really great day and a great rest of your week.